Okay, so far in our first video lecture, we looked at this concept of fair market value, and then we looked at some of the different adjustments to value, things like depreciation, things like liquidation, and strategic value. Now I want us to look at the different approaches to actually valuing an asset. So there are several ways to approach these calculations. We're going to focus on three that are commonly used or employed in the sport industry, and those are market approach, income approach, and cost or asset-based approach. So you can see I've included kind of some little short definitions of each of these here. You can see market approach involves comparing prices on similar assets. So you might use this to determine ticket prices for an upcoming season. You might look at other ticket prices within similar markets for similar products, and that might be a way that you employ market approach. Income approach, you can see, is the comparison of incomes or cash flows. So you might use income approach to determine the value of a sport franchise or fitness center. And you would do this in a number of different ways using a number of different approaches that look at income, both current and future. And we'll look at an example of that here shortly. And then finally, we have cost or asset-based approach to valuing an asset. So here you might you see that it's the comparison of costs to recreate the business. So you might use this approach to assess the value of individual assets. So this is probably more useful when you're trying to come up with the value of individual pieces of equipment or other assets that the organization owns, and essentially asking the question, what would it cost to replace these things? Okay, so those are the three approaches to valuing an asset. We're going to dig a little bit deeper into each of these now and then look at some practice cases to see what it looks like to actually employ them. Okay, so market approach to valuation. You can see here, essentially this is the most commonly used measure for valuing professional sport franchises. You can see here we're looking at the value of comparable assets that have been sold within a recent time period. All right. Now this is the market transaction approach. There are other different market approaches that one could use, but the market transactions approach is the one that's most commonly used to value professional sport franchises. And remember, here we're comparing similar prices of similar assets in order to determine value. So you would certainly want to consider values within the same league, right? Probably within the same country. We use the example here of the Houston Rockets being one of the more recent NBA teams to sell, sold for $2.2 billion. And the Clippers sold a few years prior to this for $2 billion. So you can certainly imagine that that value was brought into the conversation when Houston deal was being put in place. So that's a slight example of the market transaction approach. You can kind of think of it as a going rate for professional sport franchises, although very rare that they do actually go on sale. But this is certainly one common approach to valuing at least a sport franchise from an enterprise perspective. Like I mentioned on the last slide, you can also use the market approach for valuing individual assets. I use the example of pricing tickets by examining what other teams are doing in probably in the same region within the same league. Okay, so the next approach to valuation is income approach. So there are a number of different ways that you can apply income approach to valuation, and your textbook goes into detail about some of these. I'm just going to focus on one, which is the price to revenue ratio. And this is, again, is just one way for us to apply the income approach. There are other ways as well. But this allows us to predict value of franchises in a league based on recent sale price and annual revenues of a particular franchise. So basically what we do is we get a price to revenues ratio by dividing a transaction price, what the team sold for, by the total revenues of that team within the most recent year. So then we can use that ratio as a multiplier to determine other franchise values within the same league. So you can see that it's using the income approach to valuation, and that we do need to know what the annual revenues are for that franchise. Market approach does not take into account those revenues. So this is a way for us to probably have a better estimate to estimate certain assets within the sport industry, because it's taking into account both selling price and annual revenues. Now, keep in mind, before we look at actually applying this, I do want to make a note that this shouldn't be the only factor considered when using an income approach to valuation. You have to consider other variables, right? Things like market size, the brand, and the history behind that brand and the power of that brand, whether or not there's new facility projects occurring, if there are other revenue sources involved. So keep in mind that the income approach and using price to revenue ratio in particular is really just a starting point for franchise values in sport. The PR ratio becomes a market multiplier that we can use to value other teams within a league, but we also want to be able to consider some other factors that might either increase or decrease that number. Okay, so I want to show you what this price to revenues ratio looks like if we actually apply it to a practice case. So you can see here we've got Team X that has recently sold. They had a transaction price of $100 million and an estimate of annual revenues of $38 million. So the first piece to calculating price to revenues ratio is actually calculating the ratio. So we can see here we can calculate price to revenues ratio by taking the transaction price and dividing it by that total annual revenue. And we know this from the last slide, right? Transaction price divided by total annual revenues gives us our P to R ratio. So if we do that for our practice case here, we have 100 million divided by 38 million. That gives us a ratio of 2.63. Okay, great. What can we do with that, right? It seems kind of meaningless right now, right? But what we can do with it to actually apply it is to calculate the preliminary value of two other franchises within that same league. And all we have to know about those teams is their annual revenues, right? So for Team A, we know they had 25.2 million in revenue. For Team B, we know they have 45.7 million in revenue. So all we need is their annual revenues, and we can calculate the preliminary value of those franchises using the P to R ratio that we got from the sale of Team X. So you can see here, I've used an arrow, so we can take that ratio, multiply it by the annual revenues for both Team A and Team B. That's going to give us a preliminary value of roughly 66 million for Team A and 120 million for Team B. Again, want to keep in mind that this is just a preliminary value, right? And the reason that it's useful is that we're taking into account both sale price of another team in the league, but also the actual revenues of these other teams, right? So we're not assuming that all the teams in the league are going to be valued at the same rate, but likely that their annual revenues will play some kind of role in determining value. And also keep in mind that we want to consider these other factors as well, right? And determine whether or not this preliminary value is accurate, or maybe perhaps should be higher or lower. So you want to make sure you're taking into account all of those factors. If you want to get a little bit more practice here on using P to R ratios for income valuation, I've given you some other annual revenues for other teams in the same league. So we already did Team B and Team D, but if you want to go ahead and get some more practice, you could calculate the PDR ratio preliminary values for all these other teams. So that's another way for you to get some practice. Okay, so cost approach is the other approach to valuation that we're going to discuss. Essentially, using this approach, the owner is going to determine replacement cost of their assets in order to determine value. So essentially asking this question, what would it cost for us to recreate the business itself or an individual asset? And this can include both tangible and intangible assets, which keep in mind, we can certainly put a value on a tangible asset fairly easily, but sometimes it can be difficult to put value on intangible assets, like, for instance, brand power for a company, or other intangible assets that a sport organization might have. So basically, in order to calculate cost approach, all we're doing is adding up the assets, and then that's going to provide you with a fair market value measure, right? So for sports teams, this method is more appropriate in certain areas of sport organization, right? So valuing things like equipment, uniforms, etc. And this can also be used to value a sponsorship package. A lot of sponsorship packages being put together today include both some kind of monetary exchange and some kind of tangible good for trade. So I thought we would look at an example of that so that you can see what this cost approach looks like in practice. Okay, so calculating value using cost approach, here's a little sample case. I'll go ahead and give you a few minutes to read through this, give it a try, and then feel free to come back when you're done and we'll go over the answer. Okay, so we've got a marketing executive for a college athletic department that has secured a sponsorship with a sporting goods company. That deal is going to include $250,000 in cash payments, approximately $150,000 in football uniforms, pairs of shoes, and additional equipment. You have determined that the cost of the uniforms is $50,000, while the cost of the shoes is $35,000, and the equipment $65,000. Now, obviously, I've simplified this for you a little bit, given the case study and our time limitations. But in the real world, you would likely have to identify the cost or the individual value for those items, right, in order to utilize the cost approach. So normally it wouldn't be quite as straightforward as this, but just for the purposes of our video lecture, I wanted to give you that data. Now, using the cost approach to valuation, I want you to calculate the value of the sponsorship package. And like we learned on the last page, essentially using this cost approach in order to effectively employ it in this scenario, we basically just want a sum of the assets in order to provide a fair market measure. So in this case, we've got the $250,000, right, which is cash payments. Certainly that has value to it. And then we know for the football uniforms, we have another $50,000. For the shoes, it's $35,000, and for the equipment, $65,000. We add all those together, again, the sum of all of the items or assets, and we get $400,000, right? So using the cost approach to valuation here, we can see the value of this sponsorship package is $400,000, right? Now, of course, we know that the cash value is actually $250,000, but if we are trying to put a value on this package, the value itself would be $400,000, and certainly, providing the uniforms, equipment, and shoes has value for the team, for the athletic department. So if you are this marketing executive, you want to make sure that you're packaging in this way so that you can really identify the value there for the athletic department. Okay, so that's really all I have in terms of this discussion on valuation. A couple of things to just wrap us up here. You might be asking the question of which approach is appropriate for us to use. And then the truth is all three approaches to valuation are valid. And really, in reality, if this were something that you were doing in the sport organization that you work for, you would probably want to employ a number of approaches to valuation, right? You wouldn't just want to rely on one singular approach. You'd probably want to employ a number of approaches, integrate those findings into a single estimate or value, and then probably compare the different results that you got. That would allow you to do a full comprehensive valuation of a particular asset. And there are certain approaches that are better for certain types of assets, right? We said that often that market approach is best for valuing a sports team, and that income approach, is important because it takes into account revenues, Cost approach is probably better suited for individual assets that you can determine a cost for, maybe not as good of an approach for enterprise assets. There are pros and cons to using each approach to valuation. At this point, I think it's important for you to know the difference between the various approaches to valuation and be able to apply the various approaches if given a scenario. All right, that's all I have. Have a great week.